Stop waiting for the war to end. And honestly, stop waiting for the peace to begin either. In today's explainer, we're going to completely upend how you look at geopolitical market shocks. Right now, in 2026, the real money isn't being made by predicting who ultimately wins these global conflicts. It's being made right in the middle ground. While trillions of dollars are currently just sitting paralyzed on the sidelines waiting for some clear signal, institutional players are quietly extracting cash out of the chaos. We're talking about the mini-war portfolio, and specifically how you can hedge and actually profit during a structural stalemate.
So, let's ground this right away with a brilliant quote from analyst Terry Haynes. Stalemate is not peace. This is literally the foundational doctrine for understanding the current escalation in the Strait of Hormuz. We are stuck in a state of persistent, low-intensity conflict. Sure, there's no total escalating world war going on, but make no mistake, there's absolutely no peace dividend coming to save your portfolio. This exact lack of total resolution dictates a completely new market reality. It's a reality where having a directional conviction, just guessing if the market is going up or down, is actively punished.
All right, here's the agenda for today's briefing. 1. The mini-war paradigm. 2. The stalemate cycle. 3. The over-rotation trap. 4. Volatility harvesting explained. 5. Executing the iron condor. And 6. The defense stock barometer. Let's get right to it.
Section 1, the mini-war paradigm. We need to shift out of the old mindset.
Think about the traditional regime versus a 2026 mini-war regime. In the old days, you had clear momentum. You'd buy gold or bonds as these super predictable safe havens during a crisis. But in 2026, we're dealing with totally paradoxical correlations. Gold is actually failing as a hedge right now. Why? Because the exact same energy inflation that's causing the crisis is forcing bond yields up, and those higher yields absolutely crush gold. The old playbook is just broken. Your investment goal can't just be capital appreciation through a long-term trend anymore. Instead, you've got to focus on capturing volatility oscillation. You literally have to learn how to profit from time decay.
Section 2, the stalemate cycle. Let's look at the commodities caught in the crossfire. Picture the geopolitical chokehold driving this whole cycle. Roughly 84% of the crude oil and condensate moving to the Strait of Hormuz goes straight to Asian countries. So the second a rumor of a blockade or a drone strike hits the wire, we see these massive, temporary shockwaves rip through the system. But here's the crazy catch. We are seeing a historic disconnect between the physical oil market and the paper futures market. The refiners absolutely panic for immediate physical supply. It's like shoppers hoarding bread right before a massive winter storm. But the futures market, the paper market, calmly bets that the storm will pass and the strait won't totally close.
Here's how this builds into a totally predictable cycle. Day 1, a rumor of an attack hits, and oil immediately spikes 2 to 5%. Day 3, central banks start sweating, sounding the alarm on inflation, and the dollar strengthens. Then we hit week 2. The U.S. Navy announces their Project Freedom escort missions. The market perceives the threat as managed, and the price action completely flatlines. Finally, by week 4, we get mean reversion. The system bends, but it doesn't break, and those initial panic prices drop right back down to earth.
Section 3, the over-rotation trap. This is a brutal truth about behavioral finance.
Listen closely, because this is exactly where so many investors are just bleeding capital. Famed investor Howard Marks always taught us that the market swings like a pendulum between greed and fear. But in our 2026 stalemate, that pendulum has shifted to hope versus disappointment. People are over-rotating. Think about it. You hear a rumor of conflict, you panic, and you buy oil at $110 a barrel right at its absolute peak. A week later, the escorts arrive, someone whispers the word ceasefire, hope returns to the market, and you panic sell at a loss. You're essentially buying the fear and selling the relief, getting chopped to pieces by a market that's just wildly vibrating in place.
Section 4, volatility harvesting explained. Let's talk about the solution.
So, the million-dollar question is this: how do you profit when the world is just spinning its wheels? I really want you to rethink your absolute need for a directional market trend. Stop trying to guess if an asset is going to skyrocket or crash, and start betting that it's going to stay trapped right there in the middle.
Enter volatility harvesting. This is the ultimate institutional tool for a market that's plagued by false breakouts. When a headline hits, like a drone strike in the Gulf, fear spikes. That fear drives up implied volatility, or IV, which makes options premiums incredibly expensive. It's exactly like a hurricane approaching the coast. Suddenly, everyone wants to buy flood insurance, and the premiums absolutely skyrocket. By selling options during these panic spikes, you get to act as the insurance company. You collect that massive premium, and when the storm misses the coast, When the inevitable disappointment hits and things de-escalate, volatility is crushed. You profit from that crush and from the simple, relentless decay of time, a Greek metric known as theta.
Section 5. Executing the iron condor. Let's get into the mechanics.
We use a derivative structure called the iron condor to harvest this sideways volatility safely. It's built in 4 legs. First, you sell an out-of-the-money put below the current price to collect premium. But to protect yourself against the catastrophic black swan drop, you buy a further out-of-the-money put. That's your tail risk protection. Then you do the exact same thing on the upside. Sell a call above the price to collect premium and buy a further out call for protection. You've just built yourself a directionally neutral profit zone. Imagine putting up bumpers on a bowling alley lane. As long as the stock's price bounces back and forth between your bumpers, your short strikes, those options expire worthless and you keep the cash.
Now, for the elite technical parameters for 2026, you cannot just guess here. You want your short strikes at a 15 to 25 delta, which basically means there's a 75 to 85% mathematical probability they expire worthless. You want 30 to 60 days to expiration, because that's the sweet spot where theta, time decay, really accelerates. You only deploy this when IV rank is above 30, meaning the market fear is actually high enough to pay you well. And this is critical, your exit rule. You close the trade the second you hit 50 to 75% of your max profit. Do not hold to the very end. If you do, you expose yourself to late cycle gamma risk, which is the risk of a sudden, explosive price move near expiration that can turn a winning trade into a massive loss over a single rogue news headline.
When you map all this out, you're just looking at prices zigzagging. They react to the daily news cycle, sure, but they refuse to break out of their established channel. By using strict risk management, setting your condor wings, your risk guardrails, way outside that daily noise, you are literally extracting cash from a stagnant price. It's quite literally the perfect mechanism for trading a geopolitical stalemate.
Section 6, the Defense Stock Barometer. Let's apply this to a real-world sector.
Let's use Lockheed Martin as a perfect case study. If you look at its discounted cash flow, its intrinsic value early in 2026 was hovering between $470 and $500. But because of the constant Mormuz friction, it frequently traded way up above $550. That $50 gap, that is not company value. That is pure geopolitical risk premium. You don't blindly buy and hold Lockheed at $550 anymore. You trade the range. You buy near its intrinsic value during a peace rumor dip, and you harvest the volatility by selling call spreads when the ultimatum headlines push it into overvalued territory.
And hey, there's a huge secondary insight we absolutely need to factor in here. While everyone is distracted watching the oil in Hormuz, Pentagon planners are quietly watching the rare earth metals choke point. Over 90% of these critical alloys, which are literally vital for everything from F-35s to advanced missile systems, have historically been concentrated in China. With the new U.S. defense procurement rules kicking in on January 1, 2027, which prohibit Chinese origin materials in American defense systems, we're seeing a massive shift. We're moving from maritime friction to domestic supply chain sovereignty. This is going to create entirely new ranges and channels to trade in the defense sector over the next year.
So I leave you with this final thought. What's it going to be? Are you going to keep sitting on the sidelines waiting for a definitive peace treaty that might never come? Waiting for a clear, easy bull or bear market is just going to erode your capital through inflation and lost opportunity. The mini-war is already here. The market is oscillating. It's time to master the middle ground, harvest that volatility, and trade the stalemate. Thanks for joining me on today's Explainer, and I'll catch you next time as we keep decoding the data.